Hello everyone, this is Macroeconomics. So today we are going to go through this chapter 14 to talk about money, bankings, and the Federal Reserve System. In this chapter, we are going to first explore what's the meaning of money, what's the functions of it, why is it important to have money, and then we would like to actually talk about the measures of money supply. Well, in the United States, the banks actually is one of the financial intermediaries that actually deal with money. So we want to know the rules of the bank and who determines the money supply in the country. At the end, we would like to also talk about the Fed, which is the Federal Reserve System in the United States. They're serving as a central bank in the United States. So first, our question is, what is money? So money, basically, it's an asset where people actually use to exchange for goods and services, or maybe sometime make payments of the debts. So the idea is, whenever we go out there to trying to get something that we like, we can basically use this asset called money to exchange for something that we actually want to get. So this is the key functions of money and the reason why we want to hold on to the monies. If we go back in time, let's say we are back to the barter economy system. Now you can actually recognize how important money is. Let's suppose there is someone that can offer you a haircut and they want to exchange this service with something that they want. Well, this tall guy right here who can do a haircut, who wants to get economic lessons, he has to find that shorter guy in the world that is willing to teach him economics, and also at the same time, this shorter guy can actually accept the haircut services. Well, in this case, we call this exchange a double coincidence of wants. It only happened coincidentally that you can actually bump into the guy or maybe to the merchants that can provide you that service or the goods that you really want to exchange. So it's very difficult to get something that you actually want. In a more advanced economy, well, people actually use different forms of money to exchange. And there is one particular kind that we call the commodity money. This is a very popular money that people use for exchange the goods and services. So back to the colonial time, the governor of Tennessee was actually accepting this 100 deerskin per year as a salary, whereas the state's secretaries of the treasuries, he was able to actually accept 450 otoskin per year as a salary. So what we call commodity money, which is a form of commodity where people widely accept and they are willing to give up the goods and services in order to exchange for this commodity. So you can actually imagine, maybe for this one otoskin, you can exchange maybe 2 cases of apples, where this one deerskin can actually exchange for maybe 2 cups of tea. So deerskins, otter skins, or any kinds of animal skins were widely accepted as a commodity money back in the time because they can be used in many different things. So those animal skins can be cut and customized and make something else, like bags or maybe clothes. And that's the reason why people are widely accept the animal skins as a form of exchange. Well, why we need money in modern economies? Well, obviously, we have seen in the barter economies and the commodity monies, neither one of the other actually help facilitates the exchange. Well, maybe the commodity money, it's a little bit better forms of money to make exchange easier. But we need something that actually makes the exchange even more convenient for people. Well, the reason is because when money become available, well, people in the economy, they can actually specialize on something that they're really good at and spend less time to worry about counting, well, what one deer skin worth for 5 apples, or maybe 2 auto skins worth 2 cases of beers. The money that we assume can actually help people to specialize and be more productive to pursue the comparative advantage in the economy. And also, when exchange becomes so easy, it actually reduces the transaction cost. It takes less time, less efforts for people to make the exchange in the markets. Well, you can easily think about how difficult it is when the commodity prices become so complex. Suppose there are 3 goods that can be exchanged in an economy. Well, with this good A, good B, and good C, we actually need to figure out several ways how people can exchange for these 3 different goods. So first, we have to figure out, well, how much good A worth for good B. And then we have to figure out how much good A worth for good C. And as well as we have to find out, well, how much good B worth for good C. Well, when there are 4 goods, A, B, C, and D in the economy, you can easily see how this expands. So we have to figure out how many good A's equals to how many good B, how many good A equals to how many good C, how many good A equals to how many good D, and how many good B equals how many good C, and such. Well, if we have only 4 goods to deal with in the economy, that would be not too difficult. But the problem is, what if we have 5 goods or even 100 goods? It makes exchange so difficult to count, and we have to keep every single combinations in our heads. So at the end of the day, we want to actually create something that we call money that serve at least these 3 key functions in the economy to help exchange become easier. Number 1, we want the money to serve as a medium of exchange. So what I mean is, people can widely accept this money to exchange for goods and services. People realize this is something that they can actually take and be able to get something they want later. Number 2, this asset that we call money has to serve as a unit of accounts. So what it means is, when people actually getting a $1, well, they know exactly how many cans of Coca-Cola they can get from this $1. It makes it so easy comparing to the commodity monies. We don't have to keep all these different combinations anymore in our heads. We can basically just tell people, well, for the $10 that we have in the pockets, we can buy 10 Coca-Cola and 2 packs of cookies, 3 packs of chips, and 1 pizza. Well, at last, this money has to be a store of value. That means, well, people who actually holding to this money, they know that they can actually depend on this money can store value for a long time. It's not something that they get and then it will turn bad and no one can use it again. So what can serve as money? There are 5 criteria that makes a good, suitable use of the medium of exchange. Number 1, this money has to be acceptable to most people. So that means to make it a good medium of exchange, well, most of the people living in the country or maybe in the world has to accept these forms of money to exchange for goods and services. Number 2, the standardized quality makes it easier for people to depend on it. So the units should be identical. Well, think about the problem of the deal schemes. The deal schemes that the governor accepts could be in different shape or different size or even different quality. So how many apple can this governor exchange for one deal scheme may not be the same as the one that he's holding on hand comparing to the one that he has at home. The standardized quality makes it very, very easy for people to realize how much goods and services it's worth for that $1 or maybe $10 values of currency. Number 3, the money has to be durable. So it cannot be easily lost by spoilage. It's not like you put the money into a dishwasher or maybe put it into a clothes washer. It will break. It's not like you're holding a coin on hand. After a while, it will melt down. So the money has to be durable so that people can actually use it for many times. And number 4, the money that we want to create in this economy should have a valuable relatives to its weight. So the trade can be easily transported. So weight is very important, especially when you think about back in time where commodity money, people has to carry these deer skins, shells, or different commodities to the market to exchange for the goods that they want. And not to mention, gold is one of the types of commodity money because gold is commodity. Carrying gold around can be very difficult because it's so heavy to carry around. So we want this money to be easily carried around and people can actually pay whenever they want. And the person who receives it can also easily carry it around too. And number 5, this money has to be divisible. So that means it should have different values of it so that people can break it down into a smaller value. Unlike the deer skins case, where you want to buy one apple from the market, you might have to cut a little piece of that deer skin to exchange for that. When the money is divisible, well, you can actually pay 25 cents for an apple in Trader Joe's, or maybe you can actually pay a $10 bill to get the Coca-Cola from supermarkets, where people can always give you back the change in returns. So it makes exchange so easy and so convenient. Well, the types of money that we have described so far, it's what we call the commodity money. Well, gold in the 19th century, it's a very popular one. In the modern days, we actually don't depend so much on the commodity money because number 1, gold has a very difficult technical problem to overcome because the value really depends on the parity of the gold. And it's very easy to cheat in the markets to mix other metals into the gold to make it heavier. Well, another problem for commodity like gold is that money supply can be very difficult to control. So the money supply here we are basically describing, well, how much gold can we get into the markets? And it really depends on the mining. Whereas maybe we will have 1 year, we found this gold mine in South Africa. The money supply of gold, which is the supply of gold, can expand tremendously. As comparing to another year where we find no new gold mine in the world, the money supply will not change. So it's very unpredictable of this gold in the world as comparing to something that can actually made by the government authority. And also, it makes it very, very difficult to exchange or make transactions with the weights of the gold. Well, to solve these problems, the modern economy actually depends on what we call the fiat money, which is the paper currency, including the US dollar, Japanese yen, Chinese renminbi, and all the other different kinds of paper currency that we actually see nowadays in the world. Well, in the United States, the federal currency, it's also called a legal tender in the United States. It actually means that the federal government require that it's to be accepted in the payments of debt, and also require that cash or check denominated in the dollar can be used in payments of taxes. So this legal tender makes it very, very important meanings for people to pay off the debts or maybe to pay taxes in the country, because this is the only forms of money that the US government will accept. So we know this fiat money, it's so convenient and meeting all these criteria that we actually draw out. But how to measure the size of this money? So the study of the money supply sometimes can be difficult because, well, the money is not only in our pockets. Sometimes the monies are actually in the banks or maybe in different forms. To study the effect of money supply, well, we have to actually take a look at the measures of money. Congress in the United States actually give the Federal Reserve, which is the central bank in the United States, the responsibility of regulating the monetary base, which is the total currency in the United States, and the task of determining how to measure it. So there are, in general, two measures of money supply in the United States. They're very easy to remember because the first kind is what we call M1, which is the most liquid ones. And the second one is called M2, which include the liquid assets in the United States and some not liquid assets in the United States. So the total measures of this monetary base or money supply, also sometimes called the monetary aggregates, because it is the total aggregated supply of money in the country. So let's talk about M1. We also call this M1 a narrow definition of money supply because, well, the definitions of this M1, it's very narrowly defined. It only includes certain assets in the United States. Number one, it includes all the currency, which is all the paper money and coins that are held by the households and firms. It also includes the values of all the checking account deposit in the banks. and the values of all the traveler checks that issue in the United States. Well, to kind of get a sense of this M1, basically it includes only the currency and the values of money that can immediately use to buy goods and services. And that's the reason why we call this a narrow definitions of money supply, because it only includes the values of money that can immediately used in the economy. So, M1 is the most liquid asset in the economy. It actually means that people can use this M1 to buy or get exchange for goods and services that they want, and also make payments of their debts. So the word liquid actually means, well, how easy it is to flow from one person to another person in the exchange or transactions. In the year of 2013, the total amount of currency in the circulations was about $1.1 trillion in the United States, which is more than $3,500 per person, including the adults and child in the United States. But more importantly, most of the currency, about 60% of the currency in the United States, is actually sitting outside the border of the United States. The currency were holding by either the foreign banks, the foreign countries, and the households and firms in those countries where local currency is not stable. So most of the currency that actually we create for people to exchange for goods and services are actually held by the foreigners. So M1 is the narrowest definitions. Contains only the currency in the circulations that it's readily for people to buy goods and services. M2 is a broader definitions of money, which M2 include all the values in M1. That means all the readily money to make purchase of goods and services, plus all the non-liquid form of money, or sometimes we call this a near monies, which is usually the financial assets that aren't readily usable as a medium of exchange, but can be readily converted into cash or checkable bank deposits. One big part of this M2 is the value of the saving account deposits. So the value of saving account deposit, they are not readily used money because, well, every time you're trying to use your money in your saving account, you have to either, number one, withdraw your money from the bank so that you can use the currency to buy goods and services that you want. Or number two, you have to actually transfer those funding into your checking account so that you can use your debit card or your checks to pay for the goods and services that you want. So the money you actually put into your saving account, it's not a money that can use for exchange. There are other kinds of assets that we also count in M2, which is what we call the small denomination time deposits. So the time deposits, sometimes we call this a CD account, the certificates of deposits. So this is a specific kind of account that actually allow people to earn interest by depositing that money into this long-term accounts. Well, people can still withdraw their money anytime before the maturity dates, but usually people will have to pay a penalty for it. It also includes all the values in the money market deposit account in the banks, such as mutual funds, bonds, and treasury bills. So those are the deposits that people can actually make in order to earn interest. So the idea is people actually give up the liquidity of money and to get interest payment for the future. Well, in the United States, the total amounts of M1 is only account for 24% of M2, and majority of the M1s they are from the checkable bank deposits, which is about 56% of the total M1. And the currency in the circulations account for about 44% of the total M1. If we are going to put M1 into the measures of M2, the majority of the M2 assets coming from the saving deposits in the United States, and the second largest will be the M1 measure, which is the currency plus the checkable bank deposits. And there are about 6% that are from the money market funds and 5% from the time deposit, which is the CD accounts. Well, a lot of people actually confuse about money with the use of credit card or debit cards. In fact, whenever people using a debit card to pay for goods and services, the merchants actually getting the money directly from your checking accounts. So that means when people they are using debit cards, they are actually using M1 to make purchase or exchange for goods and services. However, for credit cards use, people are not actually using any of the liquid assets or non-liquid assets from the bank account to make purchase of goods and services. You are neither using your currency in your wallets. So credit card, it's not count as any forms of money supply in the economy because, well, the credit card use, it's basically a borrowing process of people actually having the credit card company make payment first and pay back the credit card company later. So in this case, all the exchange and transactions made by credit card does not count as the use of our currency. So credit card is not part of our monetary measures here. Now that we learn about the functions of money, well, what's the use of money and how we measure it, I think nobody can talk about money without banks, because banks is the financial intermediaries that actually deal with money every day. So in this chapter, we want to know about the bank operations and also to find out, well, how banks actually create money in the economy. Before we get into the operations part, well, we want to know what banks had the rule in the economy. So number one, bank, it's a profit maximizing operations in the economy. So they are private businesses, they are not the government. So the objective is always trying to maximize its profits, just like all the other private businesses. Banks can be small or sometimes can be large. Depends on how many branches they have. There are some smaller banks, local community banks, as comparing to the larger size national bank like Bank of America, Wells Fargo, or Chase. Banks has a function to accept deposits. or sometimes we call this a bank vault, and to make loans using the deposits. So the key functions here is to actually accept deposit and promise the depositor that they are going to pay interest payments on the deposits. And when they receive that deposit, they will try to find someone who wants to borrow money and make a loans to those people to charge them a higher interest rates so that the bank can actually earn a profits. Well, bank is actually serving a key functions in the money supply process, and we are going to see how they create money in the economies. To study the bank operations, we have to use this very simple tool that we call a T account, or sometimes in the business world we call this a balance sheet. So in the bank's balance sheets, there are always two columns. One is the assets of the bank, and the other one is the liabilities of the bank. So on the left-hand side, the assets of the banks are basically the bank's owns. It includes the bank reserves, the loans that the bank actually make, the securities that the banks hold, the buildings, equipment that the bank bought. So those are the assets that actually the bank owns. On the right-hand side, the liabilities of the banks include all the deposits from the depositor, the short-term borrowings, the long-term debts, and other liabilities. So yes, the bank also borrow money from the others. And these liabilities are the bank owes. So in this T accounts or the bank's balance sheets, you will always find the two sides are basically balanced. So you can actually see the total assets will always equals to the total liabilities at the bottoms. So the bank operation is based on how much money they have received from the depositors to the fundings that they can actually kick out and lend it out to the borrowers to earn high interest returns. So how much the bank can actually lend out? Well, in the United States, it's a very common practice. We call this a fractional reserve banking. That means, well, the banks usually will only lend out a fraction of the total deposit liabilities. And by law, the banks are required to keep at least 10%, what we call the required reserve ratios of their checking account deposit as their reserve. So this required reserve ratio is actually set by the Federal Reserve, which is the central bank in the United States. So for example, if the bank has $1 million of checking deposits in the system, that means the bank is required by law to keep at least $100,000 out of that 1 million deposits in what we call the bank vaults. So this is basically a vault cash or a reserve that is saved by the bank that they cannot actually lend out. It also means that the bank can maximally lend out $900,000 to the borrowers in the market. So let's suppose if the required reserve ratio is really 10% in the United States, but the bank only lend out, let's say in this case, the bank has $1 million checking deposits, but only lend out $750,000 to the borrowers. That means the bank is holding $250,000 of reserve. Well, since the required reserve by law is $100,000, it actually means that the bank is holding an excess reserves of $150,000 above what is required by the law. Again, look at the number. What we mean by excess reserve is using the current total reserve, which is $250,000 of the bank, subtract the required reserve by law, which is the $100,000, 10% of the total deposits. So, what's the use of this excess reserve? Well, think about this. If the required reserve is set for the bank to not use it or lend out, well, the banks are usually given the incentive to hold more than just what required by the Federal Reserve. Think about these situations where the bank only holds $100,000 of reserve in the bank, but some depositors, they actually walk into the bank and say, well, you know what? I want to withdraw $1,000 today. Since the $100,000 cannot be touched or cannot be withdrawn because it's required for the bank to withhold, it makes it difficult for the bank to actually pay back the depositors the money. So it will create a problem if the bank is not holding any excess reserve. So the use of excess reserves is at any time if there are some depositors walk into the bank and trying to withdraw money, the bank will make sure that they have enough money to pay back to the depositors. Now, we would like to actually think about, well, how the banks are creating money in the economy. Well, let's suppose there's a depositors in the economy who wants to actually deposit the money that he or she found under the bed. So one day he woke up and found that there are some money hidden under the bed, and this depositor deposited the money to the bank. Well, the bank immediately trying to kick out the funding to some borrowers in the economy, because the bank objective is to always earn profits. The earlier the funding get out, well, the earlier the bank will earn profits. Let's say this borrower is trying to make purchase with this money. So the money was used to make purchase of this car, and of course the money will end up going to the salesman of this car dealer. Now think about this person who sells car. Is he going to immediately spend the money into the economy and buy goods and services? Or do you think the money will end up going to the banks? Well, in order to see how money is created in a bank system, well, let's use the story we just talked about. Let's suppose there is a $1,000 new deposit goes into the bank. It becomes the liability the bank has to pay back to the depositors later. However, it also means that the bank has this $1,000 of reserve that the bank can lend out. Well, by law, this bank can only lend out as much. Let's say 10% they have to keep, but they can actually get $900 out to someone as a loan. this $900 will be loaned out, and someone will get this $900 in deposits. So let's say, well, this person actually taking out a loan and put it into his accounts so that he can actually use this $900 to make purchase of the car. Once the person makes the purchase of the car, this deposit will go away. The money will be received by the salesman in the car dealer. And this salesman will actually put this $900 into his bank. Ooh, the $900 actually goes into his bank. Now Bank B actually has this new $900 deposits, and it creates $900 reserves. So again, Bank B will immediately want to kick out the funding to earn interest. But Bank B is not going to kick out total of $900 because Bank B has to hold at least 10% of this $900 into the reserve. So 90% of this money will be kicked out by Bank B and to make loan to someone else. Doesn't it sound like a very similar story when we talk about the purchase, the expenditures in the economy, where people will actually earn this income and they will spend a fraction of this income on the next person, and the next person will spend a fraction of that income to something else. So this process will go on and on and on. The banks will have the incentive to keep lending the money out as long as there is new deposits. So we end up to have this multiplier effect, and we call this a deposit multiplier. So the idea is when the first $1,000 get into the bank system, not only $1,000 is being created in the bank system, but people who actually loan 90% of that $1,000 will spend on something else, and the money will go into another bank, and that will create another new deposit. And then the bank will keep loaning the money out by a fraction of it, and this will keep going and going and going and going until we get into this infinite sum. And we have studied about this infinite sum before. So the multiplier, or the deposit multiplier, it's equal to 1 over 1 minus the maximum amounts or fractions of that total deposits to loan out in the bank, which is 90%. And by looking at this multiplier, we know for every $1 new dollar deposit to the bank, because the bank will keep loaning out, and that $1 will end up creating $10 in the economy. And that's how banks create money in the economy. So the total increase in deposits will be $1,000 times 10 in this case, which means for that 1,000 extra new money goes into the bank system, the banks will keep loaning to create end up $10,000 worth of money. So this simple multiplier can also be rewritten in the following form. We don't have to use that 1 over 1 minus something, but indeed the 1 minus 90% is the 10%, which is the required reserve ratios. So we can actually write this formula for the simple deposit multiplier to 1 over the RR, which is the required reserve ratios of the bank. But this simple deposit multiplier has some very unrealistic assumptions. Number one, we assume all the banks are not keeping any excess reserves, which we have talked about. It's very unlikely to happen because the banks want to make sure that they have the money to pay back to the depositors when the depositor comes to the bank to withdraw money. Number two, we assume the amount of every check it's deposited in the bank. So no one want to keep the cash. So even the salesman who received the money by selling the car, we assume the salesman will always deposit the total amount that he received into the bank, which again, people usually will want to keep some cash on hand. So that means, well, it's not necessary. People will always deposit the total amount into the bank. So with those assumptions, we know we are oversimplified the deposit multiplier. And indeed, the actual real-world multiplier or deposit multiplier in the United States is about 1.6. So for every $1 new goes into the bank system, the bank system will keep loaning out until the end it creates $1.60 in the bank system. So the idea is, if the bank reserves increase, that means, well, when someone is depositing the money into the bank system, new money we're talking about here, the money supply in the countries or in the economy will increase. However, when the bank reserve decrease, it will cause the money supply to decrease. Well, talking about the bank's operation, it's interesting. But of course, we cannot only focus on the commercial banks in the markets, because banks will also have its problem in our economy. As long as the bank is a business, it's always a possibility for the bank to fail, just like all the other small businesses. So for example, bank can also run into a problem like this kind. When the bank one day has all this depositor coming into the bank and trying to withdraw their deposits, it's not necessary that the bank will have enough money to pay back to the depositors. And in this case, we call this a bank run. So a bank run is when a bank is experience a long lines of people trying to withdraw money all at one time. Well, in such situations, that's not that big a deal for Bank A because, well, they can always go to the rival and trying to borrow money. Well, because, well, who has more money than another bank? So bank borrows from the banks are very, very normal and regular activities. But the problem is, well, what if Bank A has all these people lining up to get the money back, and at the same time, Bank B also have all this depositor trying to withdraw the money from the accounts? Well, in this case, when the majorities of the banks in the market they are experiencing bank runs at the same time, we call this situation a bank panic. A bank panic is when all the banks are experiencing bank runs at the same time. So in this case, well, bank panics will create a big problem for the industry because, well, now Bank A needs the money, and as well as Bank B, Bank C, and Bank D. So it's very difficult for this bank to actually get enough funding to pay back to the depositors. This kind of situation actually happens during the Great Depressions in the United States, where bankers actually failed to pay back to the depositors. Well, in the year of 1913, the United States government actually determines they need some kind of authority to regulate the banks in the United States. And they created this authority called the Federal Reserve System. We sometimes call this a banker's bank, and we also call this a Federal Reserve Bank, which is the last resort of all the commercial banks in the countries. So the idea is to have this Federal Reserve System to back up all the commercial banks in the country. So whenever we run into the problem of bank panics, well, there is a central bank in the country where all the commercial banks, the smaller banks, the private banks, to actually borrow money directly from this authority in order to pay back to the depositors. When the commercial banks is trying to borrow money directly from the Federal Reserve System, it is called a discount loan. And the discount loan actually offer the banks to borrow the money at a discounted rate. And obviously, this discount rate can only be seen by the bank industry. So it's not for anyone to borrow, it's only for the banks. So if one day you are trying to buy a home and you think that you can actually get this discount rate from the Federal Reserve System, well, I'm sorry, you are not going to be able to get it because it's only available for the banks to borrow directly from the Federal Reserve System. So this Federal Reserve System, it's actually designed to resolve the problem of a bank panic, to avoid a failure of the banks. So the banks are actually regulated by the Federal Reserve too. And the bank regulations have the following four main features. Number one, to provide deposit insurance. So basically it's a guarantee that depositor will be paid for whatever they lost when the bank fails in the economy. The insurance will cover up to $250,000 of deposits that the depositor has saved in the bank system. Number two, the bank regulations also make a capital requirement. So that means the bank has to hold a substantially more assets than the values of the bank deposits. So just in case when the bank actually fails to pay back to the depositors, they have enough capitals to actually turn back into money in order to pay back to the depositors. And number three, the regulations actually set the required reserve ratios. So the reserve requirements only allow banks to actually lend out a fraction of the total deposits from the checking accounts. So it's a minimum reserve ratios that the checkable bank deposits that the bank has to hold. In the United States, banks are required to hold at least 10% of the total checkable bank deposits into the reserve. And number four, it creates this discount window where the banks can turn to the Fed, which is the Federal Reserve, and borrow the funds that it needs to pay off the depositors. So basically, it's the discount loans that we just show you. With these four main features, the bank regulation actually provide a much more stable bank environment for people to deposit their money or wealth into the bank system. It prevents the failure of the banks. So we have talked about the history of the Federal Reserve System and also the functions of this central bank and the regulations, how it stabilizes our banking system. But we also want to know the structure of this Federal Reserve System in the United States. So in the US, we actually call our bank system a fractional reserve banking system. That means the banks under the Federal Reserve System, they are required by law that they have to keep a fraction of the checkable deposits in the bank vaults. They cannot loan out everything. The Federal Reserve, or the Fed, serve as a central bank in the United States. As we have seen before, the Federal Reserve is serving as a banker's bank in order to help out those commercial banks who have problems or difficulties to pay back to their own depositors. There are 12 Federal Reserve districts across the countries. In each district, there is a Federal Reserve Bank. In San Francisco, we actually have a Federal Reserve Bank in the city. If you go to downtown one day, you can actually find that Federal Reserve Bank's building. You can actually try to visit there and trying to observe how the Federal Reserve Bank actually creates money. The Federal Reserve System actually have this meeting in Washington, D.C. They will meet 8 times in a year to discuss about the monetary policy. And this meeting, it's what we call the Federal Open Market Committee, the FOMC. This committee actually have 12 voting members. 7 of them are the Federal Reserve Board's governors. The president of the Federal Reserve Bank of New York is required to be a voting member in this committee. So that means the president of the Federal Reserve Bank of New York is a fixed member in this committee. There are other 4 members. They are basically rotated by the presidents of the other 11 Federal Reserve Banks. So instead of the Federal Reserve Bank of New York, well, all the other Federal Reserve Banks will have their presidents attend the meeting, and 4 of them will be the voting members in the committee, and they are by rotations. All 12 Federal Reserve Bank presidents will attend those meetings and participate in the discussions to talk about the current state of the economy and trying to figure out a solution to resolve problems at the current state. So there are 3 monetary policy tools that can be used to resolve the economic problems we have in the country. One is what we call the open market operations, and then they have the discount policy, and at last, the reserve requirements. So the open market operations is a tool for the central bank to control the money supply in the economy. In the next chapter, we are going to see how this monetary policy tool will affect the economy. But here, let's first assume that the Federal Reserve is trying to increase the money supply in the economy. So what they do is they will call up this office in the Federal Reserve System called the trading desk. And this trading desk will actually contact the commercial banks in the United States. They will inject the money into the bank system. In exchange, they are going to get the treasury bills or treasury bonds certificates from the bank system. So banks, it's a financial intermediaries that also wants to keep these treasury bills from time to time. So this bank actually hold different types of assets, and the treasury bills and treasury bond certificates are the most secure assets that they can hold over time. So when the trading desk is injecting the money into the bank system, in return, they are collecting these treasury bills and bonds. You can see the commercial banks will have less of these assets, but in exchange, they will get more in reserve. So this reserve added to the bank will actually allow banks to loan out the money in order to get profits. So the Fed actually is not printing money to create money in the economy. So there are a lot of people actually saying that, well, the Fed is always printing money so that we can pay off all this different debt that we own. Indeed, that it's not how we create money in the United States. The Fed is actually going to engage this open market operations to inject the money into the bank system and allow banks to loan out the money in order to create new money in the economy. So the idea is when the Fed increase the money supply by buying the treasury security, and the Fed can also reduce the money supply by selling the treasury security to the bank and take out the cash from the bank. So at the end, well, you don't want to tell people, oh, when the United States is running out of money, the Fed is going to print more money to pay off our debt. They are not. So the discount policy, it's basically another policy tool that the Fed used to change the money supply in the economy. The idea is the Federal Reserve can actually lower or higher the discount rates in order to discourage or encourage the bank to take additional loans in order to increase the reserve in the system. As reserve increases, the money supply will increase. That means when the Federal Reserve is setting a higher discount rate, banks will feel like, well, they have to pay a very high cost to get those extra loans from the Federal Reserve. So they would like to keep more money in the reserve. So the money supply will reduce because they are not loaning out the money. On the other hand, when the Fed is trying to lower the discount rate, it actually encourages the bank to take additional loan so that the reserve in the bank system will increase, so money supply will increase. Also, the Fed can use another tool called the reserve requirements. So this is basically the regulations that the Federal Reserve can change in the bank system. As we discussed before, the required reserve ratio in the United States is 10%. If the Fed one day is lowering the reserve requirements or the required reserve ratios, the banks in the system will feel like the constraint for loaning out the reserve is relaxing. So they will be a little bit more motivated to loan out the money or loan out the reserve to earn interest payments. When banks loan out more money, the money supply again will increase. However, when the Fed is trying to higher the required reserve ratios, well, the bank will feel the pressure so that they have to keep a higher level of reserve in the bank vaults in order to meet the regulations. So after learning the policy tool from the Federal Reserve System, we would also like to know about what was actually happening in the year of 2008, which is the Great Recession in the United States. So everyone knows the financial crisis in 2008 is also what we call the housing bubbles. So this housing crisis is actually started in the year of 2000 to 2001. So during the year of 2000 and 2001, the United States actually just recovered from what we call the tech bubble. The interest rates was actually going very low during those times. Home buyers was trying to take advantage of this low interest rates and enter to the housing market to buy houses. Because the cost for the mortgage is low. Well, as the home prices actually increase, there are more and more people wants to buy houses. Well, banks keep loaning out the mortgage to the home buyers, and there are some investors are actually interested to actually buy those assets from the bank's mortgage. So the bank actually think about, well, how are they going to sell this assets to the investor so that they can actually get more cash in returns. So they think of a new way to repackage all these mortgages from the home buyer, which is what we call a securitizations. So if you want to think about the concept of securitization, it's basically when the bank is trying to put all this different risk level of mortgage contracts into one package or a box and pack it into one to sell it all to the investor in the market, so that the investor buying these assets will get a fixed income from the home buyers. But the problem actually accumulates through time. As the housing prices keep increasing, well, the home buyers are getting very excited because they thought that, well, the price of the houses will only goes up and never get back down. So what happened is more and more home buyer joins the market to buy a house, and the bank, they are basically here for the businesses. So they are actually approving something that we call a subprime lending to some of the very, very low qualified buyers. That means the at-risk buyer, the people who are very likely to file a default to the mortgage payments. At the same time, the bank keep repackaging all these mortgages at a higher risk level and sell it to the investor in the markets. Well, if the housing prices is going to keep going up, to be honest, those people who might not have enough money to pay off the mortgage payments should not be a problem for the bank, because the bank can always get the house back from the loaners and trying to resell these assets or houses in the markets for profits. But the problem actually happens in the year 2007, where the housing prices starts to go down. The home buyers, they actually failed to pay back the mortgage payments because, well, some of these home buyers, they don't actually have a stable jobs to pay off the mortgage. Or there are some home buyers already sitting at 2 or 3 or multiple real estates that they cannot afford to pay back those mortgages. So the bank is facing a problem because the home buyer cannot pay back to the mortgage. At the same time, the houses that they invested in or to lend out the money does not worth as much. Well, the bank don't get the money, well, as well as the investor buying those securitizations package. So this is kind of like a chain effect. When the home buyer start losing these houses, they are moving out, they have to foreclosures, and the banks getting those houses back but does not worth as much, and the money does not return to the investor, everyone losing money, and that's how the economy starts to collapse. Well, as you can see, in the financial crisis in 2008, well, the Federal Reserve was trying to help on the banks to survive through the crisis. But the problem is not only they have to help the banks to survive, but the regulations has to be strengthened in order to avoid this kind of risky behaviors to happen again. So at the end of the day, many economists agree the cause of the Great Recession in 2008 are two. Number one, because of the regulations that we call long-term capital management that has the balance sheet effect in the economy, and having this company or firms and businesses trying to invest on a very risky assets investment. And of course, the housing crisis is serving as a trigger that caused the failures of the banks and the financial system. In the next chapter, we are going to try to find out, well, how monetary policy is going to help resolve the problem of these great recessions, or maybe adjusting the economic conditions during the high inflation periods. So I will see you guys next week. Bye-bye.